Hey everyone, Longacres Finance here, and today I wanted to share with you some investment themes I expect to do well in the future. Also, how I intend to incorporate them into my portfolio. If this is your first time to my channel, please subscribe for more content and hit that like button. Alright, let's jump into it. So here are the investment themes I expect to do well in the future. First one is artificial intelligence, big data, video games, eSports, IPOs, green energy, and the internet and technology overall. I intend to incorporate them into my portfolio by picking a few market-beating ETFs. And they are AIQ, which covers artificial intelligence and big data, ESPO, which focuses on video games and esports, IPO, which as its name is for IPOs, SMOG is a low-carbon ETF focused on green energy, and OGIG, which focuses on internet and technology. Let's take a quick look at each of these ETFs. Let's start with AIQ, which is an artificial intelligence and technology ETF. Let's take a quick look at the fund summary here. The Global X Artificial Intelligence and Technology ETF, AIQ, seeks to invest in companies that potentially stand to benefit from the further development and utilization of artificial intelligence technology in their products and services, as well as in companies that provide hardware facilitating the use of AI for the analysis of big data. Taking a look here over at the fund details, we can see the fund was started on May 11th of 2018. It trades on the NASDAQ exchange and currently has 85 holdings. The fund has net assets just under $100 million and the current price is $23.71. The total expense ratio of the fund is 0.68% or 68 basis points. It currently has a distribution yield of 0.10%, which is very low. But this isn't really a fund where you expect to get any dividends or any sort of that income. Let's scroll down and see what else we can see about this fund. Let's take a quick look at the performance. So year to date, it has returned around 31 to 32%, depending on whether you use the NAV price or the market price. And it's right in line with its index, which is also around 32%. Since inception, so since May 11th of 2018, it is up around 58%. Not bad for a year and a half. Taking a look here over at the fund risk stats, we can see that it has a beta of 1.14, which is slightly higher than the market. This kind of tells you that anytime the market's going to be up, we can expect this fund to be up a little bit more, but when the market's down, we can expect to lose a little bit more in this fund. It is a high-risk investment. Taking a look at the sector breakdown, we can see that 65% of the assets are invested in information technology, 18% is in communications, just under 8% in industrials, 7.5% in consumer discretionary, a little bit in finance, and we have 0.2% in other and cash. The bulk of the assets is invested in US companies, with a little bit in China, Canada, Germany, South Korea, Iceland, and a few others. The top 10 holdings at the end of October were Mutant Class B, Qualcomm, Nvidia, Salesforce, Alibaba, ServiceNow, Facebook, Samsung, Electron, Alphabet, and Tencent holdings. Based on these holdings, we can see that they're pretty diversified across a range of high-tech companies from across the globe. I believe that artificial intelligence and big data will continue to have high growth well into the future. Let's move on to video gaming and esports. I've chosen an ETF from VanEck. The ticker symbol is ESPO. That's VanEck Vector's Video Gaming and Esports ETF. Taking a look at some of the latest market updates that they have here, VanEck Vector's Video Gaming and Esports ETF has outperformed the S&P during the market volatility of 2020, as of September 30th of 2020. The video gaming industry represents a long-term structural growth opportunity supported by trends like changing customer preferences and demographics. As league owners, video game publishers are poised to benefit most from esports phenomenon. Video gaming is a global diversified industry by game and by region with both developed and emerging market consumers. So let's take a quick look at the fund description. VanEck Vector's Video Gaming and Esports ETF seeks to replicate as closely as possible, before fees and expenses, the price and yield performance of the MVIS Global Video Gaming and Esports Index, which is intended to track the overall performance of companies involved in video game development, esports, and related hardware and software. You can see the fund has total assets of $558 million with 25 holdings. It has a gross expense ratio of 0.99% or 99 basis points and a net expense ratio of 0.55% or 55 basis points. The net expense is what we're interested in because that's the actual amount you pay. The difference here is probably some kind of discount to get more people to invest in the ETF. Scrolling further down, and here we can see a fee waiver and expense reimbursement of 0.44%, which is the difference between the 99 basis points and the 55 basis points that we're actually paying. And we can see that lower expense ratio is expected to continue through February 1st of 2021. Let's take a quick look at the performance. We can see that their 1 month return is down. 3 months they're up 18%. Year to date they're up over 61%. Their 1-year return is 82%, and since inception, they're up 42%. Not bad. Let's take a look at the top 10 holdings. And we can see Nvidia, Tencent, Advanced Micro Devices, Nintendo, Sea, Activision Blizzard, Bandai Namco Holdings, NetEase, Nexon, Take-Two Interactive Software. So we can already see a little bit of overlap between this fund and the AIQ, but that's okay since we're just going to have a little bit of exposure to each. Let's take a look at the country weights. The largest portion is the United States with 33%, Japan 23%, China 18%, Taiwan 8%, South Korea 6%, Poland 4%, Sweden 3%, France 3%, and a little bit of negative exposure to other and cash. Sector weighings, the bulk is in communication, services 76%, information technology with 18%, and consumer discretionary with 5%. So let's take a look at the actual holdings of the fund. So here we can see a list of all the holdings that they currently have. We've already gone over the top 10. I also see Zynga here, Bilibili, Electronic Arts, and a few others. A pretty good mix across the globe. Let's take a quick look at the portfolio analytics here. So we've already seen the country weightings on the first page and the sector weightings. We can see a little bit of currency exposure here. It's almost half to the US dollar, pretty heavy on the Japanese yen, the Hong Kong dollar, South Korean won, the Polish zloty, Swedish krona. Something to consider here is foreign currency exposure can affect the performance of the fund because you never know what the exchange rate's going to be. So that's something to keep in the back of our heads. Let's take a quick look at the performance and the distribution. So we can see a nice chart here of $10,000 invested on October 16th of 2018 would have grown to about $19,000 as of October 30th of 2020. Not bad for a 2-year return. So while I don't play a lot of video games or esports, I have read that the industry is getting pretty hot and it seems to be getting more and more popular, and I think it will continue to get more popular into the future. So I want to just jump in and get my feet wet with a little bit of exposure to video games and esports, and instead of selecting individual companies, I think it was a little bit safer to just jump in with an ETF that's going to give me a little bit of a mix to get some exposure into the industry. Let's move on and talk about IPOs. I chose an ETF from Renaissance Capital, their IPO ETF. Ticker symbol is IPO. Pretty easy to remember. Here's a quick note from them about how it works. The ETF tracks the rules-based Renaissance IPO Index, which adds sizable new companies on a fast entry basis and the rest upon scheduled quarterly reviews. Companies that have been public for 2 years are removed at the next quarterly review. So it basically gives you exposure to IPOs as soon as they come out or whenever they review them. And then after 2 years, it looks like they dump the IPOs. So if you're interested in investing in IPOs, this seems like a pretty good starting point to jump in and get exposure to a bunch of IPOs pretty quickly and pretty easily. Let's take a look at some of the fund statistics. This is as of October 30th of 2020. Their expense ratio is 0.6% or 60 basis points. They have a couple updates here. Snowflake is scheduled to enter the Renaissance IPO ETF. Let's take a quick look at their performance. They have a pretty nice chart here comparing the performance of the Renaissance IPO ETF versus the S&P. The S&P is the dark line, the IPO ETF is this light blue line. So as you can see, it kind of tracked the S&P for a while there and even dipped below it for a little bit. But since about April, once we started coming out of this coronavirus market crash, it's really taken off and it's really outperformed the S&P. We're looking at the year-to-date return here. You can see that it peaked on October 12th with a gain of 84% for year-to-date, and it's come back down a little bit to a gain of 69% for the year, which is still a phenomenal return for the year. I expect it can fall some more if we get some more uncertainty in the market in the coming days. Here's a nice table of the performance history. So you can see the quarterly return is 28%, year-to-date 68%, 1-year return of 86%, 3 years of 25%, the 5-year return is 21%, and since inception, it's up 15.5%. And the inception date is October 14th of 2013. So not a bad return since inception. Obviously, it's done really well this year. So let's take a look at the holdings that they have in the portfolio right now. And we can see these are the holdings as of October 30th of 2020. The largest holding is Zoom. Second largest is Uber, Pinterest, Moderna, CrowdStrike, Datadog, Peloton, Avantar, Slack, Stone, Beyond Meat, Snowflake is already in there. Tencent Music Entertainment Group, Lyft, Fastly, Chewy, just kind of scanning through the holdings here. It looks like they have some solar exposure here. So it looks like right now they have 48 holdings, with the bottom 20 being pretty low exposure to the whole portfolio. They're putting a lot of weight on some specific companies here like Zoom and Uber, Pinterest, Moderna, CrowdStrike. They're pretty pretty high allocated into the portfolio. So there you go, Renaissance IPO, if you want to have some IPO exposure. Moving on to green energy, I decided to choose ETF from VanEck, the VanEck Low Carbon Energy ETF. Taking a look at their fund description here, VanEck Low Carbon Energy ETF seeks to replicate as closely as possible before fees and expenses the price and yield performance of the Ardor Global Index Extra Liquid. The index is intended to track the overall performance of low carbon energy companies, which are those companies primarily engaged in alternative energy, which includes power derived principally from biofuels such as ethanol, wind, solar, hydro, geothermal sources, and also includes the various technologies that support the production, use, and storage of these sources. You can see that they have 165 million in total net assets, 30 holdings in the portfolio as of right now. Their gross expense ratio is 65 basis points and their net expense ratio is 62 basis points. You can see that the difference is a fee waiver of 0.03% going on until May 1st of 2020. Let's take a quick look at the performance. So the performance here, you can see the 1 month return is pretty low, but it's up. 3 months, it's up 34%. Year to date, it's up 44, almost 45%. The 1 year return is up 71%. 3 years, 22. 5 year returns, 18%. 10 years, it's up 7%. And its lifetime return since 2007 is 0.3%. That's actually kind of weak. Taking a look at the chart here from 07, you can see that it jumped up as soon as it started, and then during the 07-08 market meltdown, it kind of took a nosedive, and it's taken a long time for this thing to bounce back. But we can see since maybe 2016, it's been going up, and right after the coronavirus market crash, it's really taken off. So hopefully it can take off more in the future. So taking a look at the holdings, we can see a wind system company here, Ørsted, I'm not really sure what that is, Tesla, I'm sure everyone's familiar with Tesla, Microchip Technology, another big US company, Eaton Corp PLC, NEO, which is another electric vehicle company, Solar Edge Technologies, which is a solar panel company, and a bunch of other companies here. So let's take a look at the portfolio analytics. We can see the price to earnings ratio of 39 is pretty high, but these are all growth companies, so we would expect a pretty high PE ratio here. The beta versus the S&P is 1.28, so we can expect heavy volatility. You know, if the market swings up and down, this thing's going to swing even more. You can see their exposure is predominantly to the United States and pretty heavy on Denmark, with a good allocation to China, Sweden, Austria, Germany, and Canada, and then a few other countries here. Sector weighings, it's kind of split between industrials and information technology, with a decent allocation to utilities and consumer discretionary, and kind of low on energy. Currency exposure, predominantly US dollar, kind of heavy exposure to the Danish krone, the euro, and the Swedish krone. So there you have it, SMOG, which is a low carbon ETF. I believe renewable energies will be a popular investment theme for the years to come. And if you want to get some exposure, you can do so by an ETF. I've chosen this one, the SMOG ETF from VanEck Vectors. Our last ETF here is OGIG, which is an O-Shares Global Internet Giants ETF. If you're unfamiliar with O-Shares ETF investments, it's owned by Kevin O'Leary from the Shark Tank. So let's take a look at what they're saying here. Why invest in internet and e-commerce? You get quality advantages, portfolio of over 60 high-quality global internet and e-commerce companies, investing in e-commerce, efficient, cost-effective approach, invest in mega trends of e-commerce, growth allocation, use as part of growth allocation for quality companies with growing revenues. OGIG is an exchange-traded fund that seeks to track the performance before fees and expenses of O-Shares Global Internet Giants Index. O-Shares Global Internet Giants ETF is a rules-based ETF designed to provide investors with means to invest in some of the largest global companies that derive most of the revenue from the internet and e-commerce sectors that exhibit quality and growth potential. We can see that their expense ratio is 0.48%, so 48 basis points. They currently have net assets of $480 million, so it's a pretty decent sized fund here. Taking a quick look at their performance, you can see their quarterly performance is up 16%. They're up almost 68% for the year. The 1 year return is up 87%, and since inception, they're up 27.5%. That's a pretty solid since inception return. Don't see an inception date here, so I'm not sure how long it's been around. Let's take a look at some of their holdings in there. These are sorted by weight in the fund, so you can see the largest holding is Alibaba, second largest is Amazon, then they have Tencent, Alphabet, Facebook, Microsoft, Mutant, Zoom, Snap, and Pinterest. Some pretty big names well-known names across the board. Those are the top 10 out of a total of 73 I see here. Let's take a look at the next page, see what else is in this portfolio. So we can see Pinduoduo, Shopify, Mercado Libre, Roku, Zalando, Delivery Hero, JD.com, The Trade Desk, JustEatTakeaway.com, and ServiceNow. Let's take a look at the sector allocation. So they're kind of split between information technology at 40%, consumer discretionary at 30%, and 30% to communication services. Country allocation, predominantly United States, pretty heavy on China, a little bit of exposure to Germany, Canada, the UK, Argentina, Netherlands, France, Japan, New Zealand, Israel, and a little bit of money sitting in cash. So there you go. If you think the internet and internet giants are going to do well in the future, OGIG is a pretty good ETF to get some exposure to a basket of stocks that focus on the internet and e-commerce. So I wanted to show you guys that I actually invested in all 5 of these ETFs in my 401k brokerage account with Charles Schwab. So as you can see, I have 5 shares of ESPO, 12 shares of AIQ, 6 shares of OGIG, 5 shares of IPO, and 2 shares of SMOG. My current position is between $200 and $300. I will be adding to this position over time, dollar cost averaging my way in. Here you can see my allocation to each of these funds within my portfolio. So you can see they're pretty small right now. As of right now, my target is 0.75%, so 0.75%. You can also see I have a bunch of other ETFs here that I'm slowly phasing out of, and I am investing in dividend paying stocks, and I'm slowly building out this portfolio. Hopefully once it's all ready and set, I can do a video tracking this portfolio on YouTube as well. That's it. Thanks for watching the video. Please subscribe to my channel for more videos.